Welcome back to The Explainer, everyone. Today, we are zooming in on one of the world's absolute titans of hospitality, Intercontinental Hotels Group, or IHG. We're going to deconstruct their incredibly powerful Q1 2026 numbers, figure out exactly where all this growth is coming from, and see how they're engineering some truly impressive returns for their investors. Let's dive in. We're going to kick things off with a massive number, $1.2 billion. That's the total shareholder return IHG expects to deliver in 2026 alone, which is a combination of both their dividends and a really substantial share buyback program. Now, when a company's returning that kind of capital in a single year, you know their underlying cash engine is just firing on all cylinders. But to understand how they're actually generating all that cash, we need to dig into the metrics. Before we jump into the deep end of the data pool, let's just do a quick vocab check. We need to talk about RevPAR. If you follow the hotel industry, you already know this is basically the ultimate pulse check for any major player. It stands for revenue per available room. You simply multiply a hotel's average daily room rate by its occupancy rate. So it doesn't just tell us if a hotel is full, it tells us if they're actually commanding a strong price for those rooms. Keep this metric in your back pocket because it is definitely the star of today's explainer. Here's a quick roadmap of what we'll be covering today. First, a global hospitality giant, then Q1 2026 revenue growth, followed by a regional performance breakdown. After that, we'll look at expanding the hotel pipeline, rewarding the shareholders, and finally, the road ahead. All right, Section 1, a global hospitality giant, focusing on scale and diversification. So, picture this. In the first quarter of 2026, IHG officially crossed a literal milestone. They now operate over 7,000 open hotels. That is over 1 million rooms worldwide. We're talking about 21 different brands, everything from your classic Holiday Inn to the luxury of an Intercontinental, spread out across more than 100 countries. And you know, that kind of scale isn't just about bragging rights. It actually provides them with a profound level of operational resilience. Moving right along to Section 2, Q1 2026 revenue growth and the return of the road warrior. There's a really fascinating story playing out in the travel world right now, and it's all about the definitive return of the road warrior. Think about it. Over the last couple of years, leisure travel was totally driving the post-pandemic recovery. But now? Well, leisure demand is normalizing. It's stabilizing at a healthy, but definitely more modest 1% growth. But when you look at corporate travel, wow. Group travel is up 7%, and business transient travel is up 6%. The corporate credit card is absolutely back in action, and it is driving IHG's top-line growth. Which brings us to Section 3, Regional Performance Breakdown, or the power of a diversified portfolio. This is where IHG's globally diversified portfolio really proves its worth. Over in Greater China, they saw an incredible acceleration, growing RevPAR by 5.7% as travel there just continues to rebound. Then you have the EMEA region, that's Europe, the Middle East, Asia, and Africa, posting a super robust 5.6% growth. And what's honestly remarkable here is that this strong EMEA growth completely absorbed a localized 2% RevPAR drop in the Middle East, which was due to ongoing conflicts there. Meanwhile, the Americas just kept humming along with steady, solid growth at 3.6%. So when one region faces headwinds, the others literally pick up the slack. So what happens when we roll all those regions together? We get some incredibly impressive global metrics for Q1. Overall, global RevPAR grew by 4.4%. And if we break that down, it's a perfectly healthy mix. It wasn't driven by jacking up prices, and it wasn't driven by slashing rates just to get people in the door. The average daily rate grew by 2%, showing real pricing power, while occupancy went up by 1.5 percentage points. They're successfully getting more heads in beds, and they're charging a premium for it. It's a total win-win. The CEO of IHG, Ali Maalouf, actually summed this up perfectly. He noted that they delivered a very strong Q1 trading performance by, quote, benefiting from our diverse global footprint and better than expected demand in most regions around the world. Basically, IHG's geographic spread acts like a strategic shield. It lets them capture demand wherever it spikes, regardless of whatever localized disruptions might be happening elsewhere. Let's shift gears to Section 4, expanding the hotel pipeline and fueling future fee growth. To keep all this growing, IHG relies on a two-pronged attack. On one side, you've got their established powerhouses. These are legendary brands like Holiday Inn and Holiday Inn Express that just provide steady, highly reliable global expansion. But on the flip side, you have rapid conversions. We're talking about brands like the mid-scale Garner or the premium Noted Collection. Conversions are basically existing hotels that just decide to rebrand to IHG. They are super quick to get to market, they require way less new construction capital, and they are incredibly popular right now. In fact, they drove a massive 53% of all new hotel signings in Q1. And that dual strategy builds into an absolutely staggering pipeline. Right now, they have 343,000 rooms in development across more than 2,300 future hotels. Now, why does that matter so much? Well, it comes down to IHG's asset-light business model. They don't actually pay to build the brick-and-mortar hotels. They just franchise the brands and manage the properties. So a pipeline of that size, it is basically a mathematically guaranteed wave of future fee revenue coming straight into the company's top line over the next few years.
All right, Section 5, rewarding the shareholders, or the financial payoff.
Because IHG operates that asset-light model we just talked about, they are essentially a highly cash-generative machine. And they follow a very strict, incredibly disciplined three-step capital allocation strategy. Step 1, reinvest in the business, their tech platform and brand growth. Step 2, sustainably grow their ordinary dividend to give investors reliable income. And Step 3, any surplus cash left over, and trust me, there is plenty of it, is returned directly to the shareholders via some pretty aggressive share buybacks. And this disciplined approach just keeps delivering incredibly consistent long-term returns. For example, they're targeting a 12 to 15% compound annual growth rate in adjusted earnings per share over the medium to long term. They've also proposed a 10% increase to their ordinary dividend, which keeps a 4-year streak of 10% hikes going strong. Over 5 years, they'll have returned over $5 billion to shareholders. And the crazy part? They do all of this while keeping their debt leverage super conservative, sitting right at about 2.5 to 3 times EBITDA. It's honestly a masterclass in capital management. And the immediate payoff for 2026 is already unfolding. Remember that $1.2 billion figure from the very beginning? Well, $950 million of that is going straight into a new share buyback program. And just in Q1 alone, they've already knocked out $240 million of it. By buying back 1.7 million shares in a mere 3 months, they reduced the total voting rights by 1.1%. And as we know, fewer shares on the open market means the shares you currently hold are suddenly worth a slightly larger slice of the pie. Finally, we reach Section 6, the road ahead, with momentum into 2026 and beyond. Looking ahead, management remains highly confident. According to the filings, early Q2 on-the-books revenue shows that this growth momentum is holding really strong. Now, they do acknowledge that there are wider disruptions to international travel flows, plus some localized geopolitical issues. But as we've seen, the sheer size and diversity of their portfolio means that the surges in demand elsewhere are more than offsetting those headwinds. They are firmly on track to meet full-year consensus growth and profit expectations. So I'm going to leave you with this to ponder as we wrap up today's explainer. Armed with literally billions in cash generation, a highly efficient asset-light model, and a booming pipeline driven by rapid brand conversions, which global markets will IHG dominate next? They've got the capital, they've got the brands, and the business traveler is clearly back in a big way. Thanks so much for hanging out with us, Focus Learners, and keep learning.